Good morning, good afternoon, good evening, everyone. Thank you for joining us for today's webinar. As you likely know, on the 26th of June, the International Sustainability Standards Board published IFRS S1 and IFRS S2, the first two ISSB standards. Welcome to the second part of this two-part webinar series, where we'll be introducing and explaining these inaugural IFRS sustainability disclosure standards. These standards advance the ISSB's goal of delivering a high-quality global baseline of sustainability-related disclosures to inform investment decisions and contribute to efficient and resilient global capital markets. I'm Rebecca Barr, the Director of Membership at the IFRS Foundation, and I'll be your MC for today's webinar. I manage the IFRS Sustainability Alliance, a global membership program for organizations that really share the belief in the power of building this global baseline. A couple of quick housekeeping items before we jump into today's webinar content. Please feel free to submit questions while my colleagues are presenting using the Q&A feature at the bottom of your Zoom application or browser. We'll have some time for questions at the end of today's call. However, we expect there to be many questions from today's audience. And while we will not be able to get to all of the questions during the call, we will put some helpful links for you in the chat right now, and also encourage you to register for IFRS sustainability updates so you can keep informed as our team prepares more educational materials and guidance in the coming months. My colleagues will include the links to S1 and S2 and the S1 and S2 project summary in the chat now. This webinar today is being recorded. We will be sharing the recording, the slides, and the transcript of the presentation with all attendees and all registrants by the end of this week, if not earlier. So I would like to introduce my colleagues who will be speaking today, and then we'll really jump into the content. So first, we're joined by Sue Lloyd. Sue Lloyd is the Vice Chair of the International Sustainability Standards Board. Previously, she served as the Vice Chair of the International Accounting Standards Board and played a leading role in the establishment of ISSB beginning in 2020. We're also joined by Caroline Clark-Maxwell, the project lead for the climate standard at the ISSB. Previous to that, she worked on the exposure drafts for the climate standard and was part of the technical readiness working group that provided recommendations to the trustees that were considering setting up the ISSB. So she's been working on these standards for quite some time. So with that, I'm going to turn it over to you, Sue.
Thank you very much, Rebecca, for your introduction, and hello, everybody. Great that you're joining us today. So as Rebecca mentioned, Caroline and I are going to spend the time during this webcast providing you with an introduction to our climate-related disclosure standard S2. And if you weren't able to join our first webinar on S1 last week, I really encourage you to go back and listen to that recording later, because a lot of the foundations of the requirements for disclosures set out by the ISSB are actually established in S1. I'll touch a little bit on some of that today, but to get a complete understanding, I really do recommend that you go back and listen to that webcast about S1. But today's about S2. So let's go to the next slide. So the first thing to say about S2, our climate-related disclosure standard, is that it fully incorporates the TCFD recommendations. So if you use the TCFD recommendations now, going forward, and you use the ISSB standards, you don't need to do both. By using S2, you will meet the TCFD recommendations plus more. So this is part of us reducing the alphabet soup that's sometimes talked about in sustainability reporting. And actually at the foundation, we were really delighted last week that the Financial Stability Board announced that they will be disbanding the Task Force for Climate-Related Financial Disclosures following the inclusion of the recommendations in S1 and S2. And they've actually asked the IFRS Foundation to take on the monitoring of the adoption of the TCFD recommendations going forward. So that really signifies how closely we've built on those recommendations. So looking at it at high level, what does S2 ask of companies? Firstly, it asks companies to set out disclosures about climate-related disclosures, applying S1, and I'll come back to that a little bit later on. But in terms of content, we ask for material information about the climate-related risks and opportunities that a company is exposed to. So their physical risks, such as the risk of flooding, their transition risks, how they might need to change their business model as a result of climate change, but also their climate-related opportunities. And a really important part of S2, which Caroline will talk a little bit more about later, is the fact that we do ask for industry-specific information as well as cross-industry information. And that's because investors tell us that really understanding the effects from an activity or industry perspective is really helpful to understand how climate-related risks and opportunities affect a company. So moving on to the next slide. So overall, in applying S2, the ISSB is asking a company to identify and provide information about the climate-related risks and opportunities that are really important to understand the prospects for that company's business in the future, how it's going to perform from a business perspective. And investors really need this information to understand how a company might need to transition its business, how it might be affected by physical risk, or how it might need to change its business model as a result of regulation arising from climate change, or because of things like changes in consumer preferences. We're also really interested in how climate risk might manifest in a company's value chain. That's something that's common in S1 and S2, and I'll talk a little bit more with a couple of examples about that a little bit later on. So moving on to the next slide. And S1. Now, I think one of the really important things about the ISSB's standards is that we're not just thinking about disclosures as an isolated exercise. We're thinking about the provision of information about sustainability risks and opportunities in combination with financial statements as part of the general purpose financial report, and where investors can really understand what's said about sustainability risks and opportunities in the context of the financial statements of a company. So one of the reasons why we say that S2, our climate standard, must be applied with S1, our general requirements standard, is because S1 talks about who the reporting entity is, the fact that the information has to be provided along with the financial statements and at the same time, and lots of things like what to do with comparative information, what to do if you make an error, what to do if you've got a change in estimates. And a lot of that sort of plumbing and reporting housekeeping, if you like, is housed in S1, and you need to use that to apply S2. But there's also some really important concepts in S1 that you need to understand to apply S2 well. So apologies to those of you who listened to the S1 webcast already, but just to highlight a couple that are contained in S1 that you really need to know about to apply S2 the way that the board requires. The first is that we always ask for information that is material, and that's defined, and how to assess that is set out in S1. That means that the information you provide needs to be so important that that particular disclosure, if it was missing or misstated or obscured, could be reasonably expected to actually influence the decision that an investor might make. So it needs to be an important piece of information. Another thing that you will find in S1 that's really important for your climate reporting is, what do we mean by the value chain? The value chain definition, the way to think about the value chain, that's all contained in S1. And being somebody who came from the accounting world to the sustainability world, it's taken me a while to get used to this idea that information about what's going on in your value chain, which could be very many steps removed from a company's direct activities, can come from the end users of its products or in the supply chain, for example, is really important to understand risks, including climate risk. Let me give you one example that our chair, Emmanuel Faber, used in a recent speech. If you're very reliant on supplies and inputs from suppliers that are going to send their products to you along the Rhine River, the fact that it may be disrupted because of temperature rises that cause the levels to reduce the ability to transport is a risk you need to be thinking about and managing in your business. If those sorts of risks in your value chain are at the level that it's material information for investors, that's important to be included in climate information. So that's a good example of why you need to use S1. And the last one that I'll mention is that there's relief from the provision of climate-related information about opportunities when it's commercially sensitive, and that relief is contained in S1. So if you're using S2, you need to pick up S1 as well. So moving to the next slide. As I said, S2, like S1, fully incorporates the TCFD concepts. So we ask in S2 information to be provided about governance, strategy, risk management, and metrics and targets. If you've used the TCFD recommendations, you'll be very familiar with those concepts because we have taken them and incorporated them in S2. And the really great news, if you have used the TCFD recommendations, is you're really well prepared to use S2 because we build on those TCFD foundations. Moving to the next slide. Now, I'm not going to say much on this slide because we're going to go through in some detail each of these 6 areas in the rest of this presentation. So what I'm going to simply say is have a look at the screen. Note there's 6 things here in the strategy and the metrics and target sections of S2, 6 important areas of information that form a large part of the S2 disclosure requirements. And notice that it's not just about greenhouse gas emissions. I'm sort of saying that half jokingly, but I'm saying it importantly because a lot of what you hear when people talk about S2 is you have to provide information about greenhouse gas emissions. You do. And Caroline will talk about that a lot later. But there's a lot of different aspects of how climate-related risks and opportunities might impact your business, how you're managing that, how you're assessing that, and how you're responding to that. That's in S2 that goes well over and above just providing information about greenhouse gas emissions. So moving on to the next slide, I'm going to start to set the scene by talking about the section on strategy and decision-making. And the first thing I think I'll say before I even get into the details on the slide about the disclosures that are required is that the role of the ISSB is to ask companies to provide information to investors to enable them to understand how a company is running its business, how it's undertaking its planning. And we don't tell a company how it should run its business or do things like require a company to have a transition plan. That is not the business of the ISSB. The ISSB is about providing information to the market about what a company is doing, how it's thinking about these risks, how it's responding to it, what plans it has in place, how well it's responding to them, not telling you how to run your business. So in the case of strategy and decision making, we want companies to tell their investors whether and how they've addressed climate-related risks and opportunities in their strategic planning and their decision making. So that's what S2 is asking for information about. How the company's responded to and plans to respond to climate-related risks and opportunities, how it's resourcing its plans or how it plans to resource those plans, and how well it's progressing against the plans that it has in place. That's a lot of words. So let me give you an example of a sort of disclosure that we mean here. A good example is providing information about any transition plans that a company has in place. So for example, it's greenhouse gas emission targets, what those targets are, how it plans to achieve them, and what progress it's making over time. And that's also a good point to point out that we're part of a bigger ecosystem as well. We don't set out requirements for what a good transition plan looks like or how to form a transition plan, but others, such as the UK Transition Plan Task Force, do. And when a company uses that sort of guidance, then reporting on the plans it puts in place is exactly what S2 is all about. Now I'm going to move on to another really important part of S2 on the next slide, which is current and anticipated financial effects. And this is a really good example of the point that I made really early on in this presentation, which is to say that we're not interested really in sustainability disclosures that are sitting over here, completely disconnected from the financial statements and the financial information that a company is providing. Investors have told us pretty consistently over the years that they really want to understand how the information in sustainability reporting relates to the information in the financial statements. And S2, like S1, tries to improve this understanding by requiring information about the effects in the current financial statements, the effects on financial performance, financial position and cash flows of climate-related risks and opportunities, and the anticipated future effects. So, for example, a company might disclose how an impairment of an asset was affected by its strategy to manage its transition risk. If it's changing the way it's going to use its factories or its machinery because it needs to change its way of business because of its emissions targets, how is that reflected in impairment of its assets? Or if it's not impacted, why? We also asked for information about the anticipated effects in the future. Do you affect the sales of particular products to be reduced because of changes in consumer demand or because of regulatory effects? Do you expect to sell less diesel cars, more electric cars? That's just an example of an anticipated future effect. Now, in our standard, we very much encourage and point towards the provision of quantitative information about the effects on the current financial statements and indeed the anticipated future effects on the financial statements of climate-related risks and opportunities. So that is what is required. However, we know that's not always possible. So in the standard, we've got some specific examples of when instead of quantitative information, qualitative information is permissible. And that's where providing quantitative information is not possible because you cannot separately identify the effect of climate from other risks and opportunities, where there's a very high level of measurement uncertainty that would affect the robustness of the information. And in the case of anticipated effects, on the next page, there is another test as well, which is whether there is where the skills, resources, and capabilities of a company mean that actually quantifying the anticipated future effects on financial statements is not something that is possible for a company. So this is a really good example of where the ISSB has tried to be proportionate in what we ask a company to do. So if you don't have the skills, resources, and capabilities to provide information about the anticipated financial effects in a quantitative way, qualitative information is available. And for all companies, we also have a really important provision, which is when it comes to anticipated financial effects, you are not required to do an exhaustive search for every piece of information that might be relevant. You are required to use reasonable and supportable information. You need to have a good basis for what you are disclosing. You need to make use of information that's readily available, but it doesn't have to be an exhaustive search. And the amount of effort that we anticipate that a company should make depends on their circumstances. And that's reflected in this additional message that we have in S2, that the information that a company must use to determine its anticipated financial effects is using all reasonable and supportable information that's available to the company without undue cost or effort. So this is designed to make sure that the ask we have of companies is not that you do nothing, but that you make a good effort, but it is grounded on something that is realistic given the particular circumstances of a company. And that's a really important addition in the final version of S2, same wording as in S1. And that was in response to some feedback that we got on the exposure drafts, that the previous wording that we had, where we talked about whether a company was able to do these things, was a bit vague. And so people wanted us to be more specific about the circumstances when they could provide qualitative rather than quantitative information. With that, I'm going to hand over to Caroline, who's going to take you through the next areas in S2. Over to you.
All right. Thank you, Sue. And hello, everyone. It is always a pleasure to talk about these standards. And the first thing that I get to speak about today is climate resilience, which is our third key disclosure area that we wanted to highlight in this webinar. So climate change and the uncertainties associated with that can affect the resilience of a company's strategy and business model. IFRS S2 therefore requires a company to assess its climate resilience and to disclose information about that assessment, including the implications of climate change for its strategy and business model, and its financial and operational capacity to adjust or adapt over the short, medium, and long term. IFRS S2 requires all companies to use climate-related scenario analysis to inform the disclosure about their resilience to climate change. However, IFRS S2 does not specify which scenarios a company should use in its analysis, but requires that a company use relevant scenarios and provide information about the scenarios it has selected. So in other words, a company is required to disclose the inputs and the assumptions it has used in its climate resilience analysis, in addition to the information about its climate resilience. So if we go to the next slide. S2 contains guidance to ensure the requirement to undertake scenario analysis is proportionate. This includes guidance on how a company is required to determine its approach to scenario analysis, used to assess its climate resilience. So climate-related scenario analysis encompasses a range of practices from qualitative scenario narratives to complex statistical modeling. Considering this, the ISSB decided to require a company to use an approach that is commensurate with the company's circumstances and to use all reasonable and supportable information that is available to the company at the reporting date without undue cost or effort. To determine what approach is commensurate with the company's circumstances, the company is required to consider both its exposure to climate-related risks and opportunities. So the greater the exposure to climate-related risks and opportunities, the greater the need for a sophisticated scenario analysis, but also its skills, capabilities, and resources that are available for the climate-related scenario analysis. So if you go to the next slide, because of the application guidance builds on a range of practices outlined in documents published by the TCFD. So, for example, the application guidance build upon the TCFD's stages of progression to help guide companies on how to select an approach to climate-related scenario analysis that is commensurate with their circumstances. And you can see those stages of progressions summarized on the right-hand side. The ISSB expects that this application guidance, will enable companies to develop their skills and capabilities, and therefore strengthen companies' disclosures over time through a process of learning and iteration. So if you go to the next slide, the next area that we're going to talk about is the GHG emissions, which often get a lot of interest. So IFRS S2 requires a company to disclose its absolute Scope 1, Scope 2, and Scope 3 greenhouse gas emissions. In other words, the standard requires companies to disclose their direct and indirect emissions. So some people are a bit surprised that the ISSB is asking for this information to be provided, because some consider this to be information about impacts, which they didn't necessarily expect to be an area of focus for the ISSB. If you listen to the S1 webcast that Sue mentioned earlier, you will have heard some discussion around this already. But just to reiterate that the ISSB asks for information that is reasonably expected to affect a company's future cash flows, its cost of capital, and its access to finance. And when the ISSB consulted on these requirements about GHG emissions, there was a broad agreement among stakeholders, in particular investors, that GHG emission information is necessary to understand the climate-related transition risks a company is exposed to, such as the risks associated with changing consumer preferences from high-emission products and the risk of new or strengthening regulation around greenhouse gas emissions in certain markets. That means that it may be necessary for a company to adjust the way the business is run in order to address these risks. And that means that investors need this information to assess a company's prospects. The emissions must be measured in accordance with the Greenhouse Gas Protocol corporate standard. But there is a relief here. A company is not required to use the Greenhouse Gas Protocol corporate standard if a jurisdiction requires a company to use a different approach to measurement. Not all companies currently measuring their emissions use the Greenhouse Gas Protocol corporate standard. If a company is using a different measurement method, it is permitted to continue to use that method in its first year of applying the standard. And this is intended to assist companies when starting to use the standard. So if you go to the next slide, please. In response to the ISSB's public consultations, investors communicated that Scope 3 emissions disclosures is important for understanding climate-related risks and opportunities in a company's value chain, particularly because this usually represents the majority of a company's emissions. Without information on these emissions, investors would not be able to fully assess the transition risks the company are exposed to, and the extent to which a reporting company might have transferred such risks to its value chain partners and other participants. So if we consider two consumer electronic companies that offer very similar competing products, one of these companies does all of its own manufacturing, whilst the other outsources nearly all of its manufacturing. In such a scenario, for the first company, the GHG emissions associated with manufacturing activities would fall under Scope 1 and Scope 2 emissions. However, for the latter company, it would fall under Scope 3. So therefore, based solely on Scope 1 and Scope 2 greenhouse gas emission information, an investor might assess the latter company as more carbon efficient and thus consider the company to be faced with significantly lower transition risks. However, just because the emissions associated with manufacturing have been shifted from the company to the company's value chain, the company's prospects can be affected by transition risks that are still present to companies in its value chain. So, for example, if there was emission limiting regulations on the manufacturing processes that were being introduced, such as a carbon pricing mechanism, that would affect both companies, as they would both face increased costs, whether that was internally or through higher prices that are being passed on from the value chain. So, in short, the requirement to disclose Scope 3 greenhouse gas emissions reflect the importance of providing information related to a company's value chain to more fully inform investors' understanding of a company's exposure to transition risks. As part of IFRS S2, a company must consider the 15 categories of Scope 3 greenhouse gas emissions set out in the Greenhouse Gas Protocol Corporate Value Chain Standard, with information being disclosed when material. The 15 categories are intended to provide companies with a systematic framework to organize, understand, and report on the diversity of Scope 3 activities within its value chain. So as you can see on this slide, this includes categories such as purchased goods and services and use of products sold. And if we go to the next slide, you will see that one of the categories, or you would have seen on the previous slide, that one of the categories is investment, which I just want to touch on a little bit more. S2 requires companies with activities in asset management, commercial banking, or insurance to disclose information about their finance emissions. In other words, the emissions that banks and investors finance through their loans and investments. This includes information about a company's absolute gross finance emissions, disaggregated by Scope 1, Scope 2, and Scope 3 greenhouse gas emissions, and information about the industry's finance is provided too. If you go to the next slide, while measuring Scope 3 greenhouse gas emission will often require the use of estimation, feedback the ISSB received showed that despite the measurement uncertainty, it is useful to have those estimates about a company's Scope 3 emissions. So the standard introduces a number of reliefs to support companies that are starting to evaluate and disclose emissions. So these reliefs are laid out on this slide, and a couple of the reliefs, which I will highlight today, are that a company is not required to disclose its Scope 3 emissions in the first year of applying IFRS S2, and a Scope 3 measurement framework that incorporates the use of information. And in fact, if we go to the next slide, we have a little bit more on that latter one. So the ISSB developed a Scope 3 measurement framework to provide additional guidance about the relevant information to use in measuring Scope 3 greenhouse gas emissions, which will often include the use of estimation. This framework does not specify the inputs a company is required to use to measure its Scope 3 greenhouse gas emissions. Instead, it requires the company to prioritize inputs that are most likely to enable a representative measurement of a company's Scope 3 greenhouse gas emission. So, for example, whilst data from specific activities within the value chain, what is often referred to as primary data, is what a company is required to prioritize, the framework also acknowledges and helps companies consider the secondary data that it could use if the primary data is not available, which could include the use of industry-based averages. The standard also clarifies that a company is required to use all reasonable and supportable information that is available without undue cost or efforts. In other words, in prioritizing information, a company is not required to use undue cost or effort in obtaining that information. Prioritization also implies trade-offs. It might, for example, be possible to get more granular data that is based on research that is less recent, and more recent data that lacks the same level of granularity. The framework helps lay out some of these considerations. And in developing this framework, the ISSB built on concepts and considerations laid out in Chapter 7 in the Greenhouse Gas Protocol Corporate Value Chain Standard. So for those that are familiar with the Greenhouse Gas Protocol Value Chain Standard, you will also find that there's a lot of familiar material here. So if you go to the next slide, moving on then to industry-specific requirements, which Sue started mentioning already, I think, on the first slide. S2 requires a company to disclose industry-based metrics that are associated with common business models and activities in a particular industry. As the effects of climate-related risks and opportunities vary significantly by activity or industry, such metrics are important for investor understanding. To provide these disclosures, companies are required to refer to and consider industry disclosure topics and associated industry-based metrics in the industry-based guidance on implementing IFRS S2. And this guidance is based on the ISSB standards with some modification to enhance their international applicability. And this industry-based guidance can be super helpful for companies to identify relevant climate-related risks and opportunities, as disclosure topics identified in this guidance represent the climate-related risks and opportunities most likely to affect companies in a particular industry, and the associated metrics that are most likely to result in the disclosure of material information. So this can therefore be a helpful starting point for companies to identify and disclose information about its climate-related risks and opportunities that is relevant for investors in a way that is comparable across companies in a given industry. So if we move to the next slide, please, we finally get to the climate-related targets. So IFRS S2 requires a company to disclose the climate-related targets it has set, as well as those that it is required to meet by law or regulation, including any greenhouse gas emission targets. A company is required to disclose information about the characteristics of each target, how it sets and reviews each target, and its performance against each target. In disclosing this information, a company is required to disclose how the latest international agreement on climate change, which is currently the Paris Agreement, including jurisdictional commitments that arise from that agreement, has informed the target. The standard does not require a company to have any climate-related targets, which means it does not require a company to have a greenhouse gas emission target. But if a company has a greenhouse gas emission target, the company is required to specify whether that target is a gross emission target or a net emission target. And if a company discloses a net emission target, it is also required to separately disclose its associated gross emission target. And when a company discloses net emission targets, it is required to include information about any carbon credits it plans to use to achieve that target. So if you go to the next slide, please, we will just briefly touch on some of the guidance. So as we've been going through, we've mentioned and referred to both some various types of guidance. So this slide provides a summary. In short, we have developed additional guidance that a company must use to apply the standard, and that is those listed on the left-hand side column. So the application guidance, as well as illustrative guidance and examples to illustrate aspects of the standard. That are those listed in the right-hand column. So if you go to the next slide, we can also just quickly see some of the other documents that are relevant to IFRS S2. So the Foundation has also published a number of other documents, such as the basis for conclusions, which summarizes the ISSB's considerations in developing the requirement. We talked about the guidance already, but there are also some joint documents between S1 and S2, such as the effects analysis, which describes the likely benefits and costs of IFRS S1 and S2, the project summary of IFRS S1 and S2, which is a great starting point for those that want to get the higher level summary, possibly before diving into the standards, which provides an overview of the project to develop IFRS S1 and IFRS S2. And there's also a feedback statement, which summarizes feedback on the proposals that preceded IFRS S1 and S2 and the ISSB's response. So if you've been following the process and you want to remind yourself of what the ISSB heard or the decision they made on the basis of that feedback, this is a really good document to refer to. And with that, so the next slide, please. I hope that we provided a helpful overview of S2. You can find more information at ifrs.org, which includes the standards themselves. But for now, I will hand back to Rebecca, who will open the floor for questions.
Great. Thank you so much, Caroline and Sue. That was a very comprehensive overview. So let's dive into some questions here. We've gotten some great ones in the chat, and we'll just, we have a little bit of time here to go through some of them. So first, this one's for you, Sue. We're getting some questions around the TCFD and what that recent announcement about them being disbanded will mean in practice. Could you perhaps expand on what the gap between TCFD and ISSB standards look like, how companies can approach this, especially when related to TCFD indexing that companies might already be doing?
Sure. So I'll comment on a couple of things there, and I saw a couple of questions on the monitoring that I referred to as well. So I'll build that in if that's okay. So what the announcement from the Financial Stability Board means, and if you look at our LinkedIn account, you'll see the announcement there, is really that the Financial Stability Board has met its objectives, I guess. When the TCFD was first established, I've heard Mark Carney talking about this. Their idea was to establish a voluntary framework that started people on this journey of providing information about climate that was designed for investors, but with an objective ultimately of that finding a home within standards that would be subject to regulatory oversight and more formality of application. And really the SSB's announcement last week, which they described as the culmination of the work of the TCFD, reflects the fact that they've achieved that dream in a sense, or that objective, which was taking the TCFD recommendations and then being brought into standards. And so that in part then leads me to answer the question about, what's the difference between applying the TCFD recommendations and our standards. So the first thing to say is that in a few weeks, we're going to have a formal sort of mapping between the two that will be on our website. So keep an eye out for that. But in the interim, what I can say as a starting position is that if you were to meet the requirements of our standards, S2 in particular, you wouldn't have to worry about TCFD. So it's everything in TCFD plus more. You can't go the other direction. So if you're applying the TCFD recommendations, that's a great start for the application of the TCFD, of the ISSB standards, but it's not complete. And it's not complete for a couple of reasons. One is that in some places, we've increased the specificity of the language that we use. So we're very specific about what's required around scenario analysis, for example, building from the TCFD, but going further. To assert compliance with our standards, you need to meet all of the disclosure requirements, whereas the TCFD recommendations were recommendations and people used some of them, but not all. But also we've introduced additional disclosures. Notably, I think the one that we've been talking about is the fact that we ask for industry-specific information that wasn't in the TCFD recommendation. So that's an enhancement or an addition to the standards. So great base will start you off, but it's not all the way there. So that would be what I'd say. And in terms of monitoring, the TCFD used to prepare a report annually about the take-up of information that was consistent with the TCFD recommendations. The Financial Stability Board have said that they've asked the IFRS Foundation to take over that monitoring role. So that was what I was referring to.
Great. Thank you, Sue. Mapping coming is one key takeaway there. So stay tuned to our website for more information. Caroline, let's talk about reliefs. There's a relief in S1 that states companies only have to report on their climate-related risks and opportunities in their first year of using the ISSB standard. Can you expand on what this means for the use of S1 and why companies still need to use S1 in their first year? Could you also touch on some of the other reliefs that relate to climate disclosures like the GHG protocol?
Yeah, absolutely. No problem. Although I know that Sue's going to be itching a little bit as well because it's her favorite slide, I think, and favorite topic, but I'll give it a go. Sue, and I promise to hand it over to you later for any further comments. So what that really effectively means is that if you imagine the sort of the full standard of IFRS S1 being applicable or being required, but you have a switch which sort of you flick off for other sustainability related risks and opportunities. So you'd use it the same way, but you'd use it for climate related risks and opportunities only. And the reason for this is because IFRS S2 cannot be used without IFRS S1, which lays out the conceptual foundations, the general requirements, and other overarching requirements, which Sue spoke to earlier. And I think, Sue, I can't remember if you mentioned this, but one of your examples, one of your favorite examples is that without IFRS S1, you don't have the relief, for example, on commercially sensitive information. One of the things that we've been working a little bit on in terms of guidance, and one of my examples, is often this principle of aggregation and disaggregation. So the principle that you can't aggregate information that would obscure material information. And so if you look at some of the guidance that we provided with IFRS S2, you can see how that principle is applied alongside the requirement to disclose greenhouse gas emissions. So there might be instances where there is a requirement to disclose a breakdown of, for example, greenhouse gas emission gases for various reasons. So, and using kind of IFRS S1 to help determine that. So that was, I think, the S1 part. Some of the other reliefs. So, I mean, there's hopefully you've heard throughout this presentation that there's quite a lot of different reliefs and it's kind of supports in place for these standards. So it's very much designed with proportionality at heart, and therefore kind of Sue spoke about the reliefs on anticipated financial effects. In terms of providing qualitative rather than quantitative information in certain circumstances if the company does not have the skills, capabilities, or resources. So there's mechanisms like that. We've also used reasonable and supportable information. I think that's almost a sort of string of words. That could be the string of words of the day of this webinar because we keep going back to it. So this idea that you're required to use reasonable and supportable information that is available without undue cost or effort. So it almost creates a sort of floor and a ceiling. So the information has to be reasonable and supportable, but and that's sort of the floor, and then the ceiling is that the entity is not required to use undue cost or effort. And then we've got these specific reliefs that was asked about in terms of the GHG protocol, for example, but there are some others as well. But just to make sure that I cover that off before I hand it to Sue, the reliefs on the GHG protocol, I think, are 3. So I hope and believe that I went through them in the webinar as well earlier in the presentation. But it is the relief to disclose Scope 3 greenhouse gas emissions in the first year of applying the standard. It is the relief to keep using another measurement method rather than the greenhouse gas protocol if the company is currently using that other method, so that you kind of have some time to transition over to using the greenhouse gas protocol. And then there's a sort of more continued relief, which is that if you're required by a jurisdiction to use another measurement method, and that would result in duplicative reporting burden, then you are not required to use the greenhouse gas protocol. So hopefully that answers some of that question. And Sue, is there anything you would like to add to that?
I think you did a great job actually on my favorite topic, Caroline. I think the only thing I would add is that the board made a decision pretty late actually in the redeliberations to only require reporting on climate in the first year that somebody uses our standards. And I think there was a reason we didn't just say S1 starts to be used a year later. We said you have to use S1 and S2, but as Caroline nicely said, we've said there's a switch that says in the first year you can switch just to climate content. But you need the language, the reporting framework, because this isn't just a set of disclosures about sustainability. This is a new way of reporting. And S1 introduces the new way of reporting. And then S2 says, and by the way, as part of that report, here's the specific information we've identified for climate. And so you still need those supporting framework to complement the disclosures. So, yeah, but good job, Caroline.
Great. Thanks to you both. So we're getting some other questions about the announcement CDP made around aligning their questionnaire. Sue, do you want to speak to this question a little bit? Specifically, what we're hearing is, the ISSB standards are about disclosure within general purpose financial reporting, which is different to the nature of the CDP platform, which is about answering a questionnaire. Could you expand on what alignment with CDP means in practice for S2?
Yes, happy to. So this is really making sure that if a company is using the ISSB standards, and so they've gone to the effort of, pulling together these disclosures on climate to communicate, that they can use that same data and information to populate their questionnaire when they respond to CDP. So it's all, a lot of what the ISSB is about efficiency and effectiveness, not having companies doing things twice for different purposes. And I think this is a really good example of that. Want climate information? Use the S2 information, and that will feed into your CDP reporting. Tick the box, happy times, efficient reporting. And that's really how I see this working.
Great. Efficiency and effectiveness. I think 2 words many people be happy to hear on this call. Another question here for you, Caroline, on Scope 3 and the GHG protocol. So we're getting some questions about the challenges in calculating this and how to make the decision to exclude this information if it is not material, especially in the context of downstream categories. Furthermore, we're also getting questions about whether companies need to disclose why some of Scope 3 categories are not considered material information. Could you just expand on this question?
Yeah, happy to. So, yeah, absolutely. So in terms of so this is about materiality in Scope 3, right? And so IFRS S2 does require that a company must consider all categories, for example, of Scope 3 greenhouse gas emissions. So if emissions from some categories are immaterial, the disclosure of those emissions are not required. So we're not requiring disclosure of immaterial Scope 3 information. However, and I think maybe, and I don't think at any point we require disclosure of why something hasn't been considered material, although of course it is possible to provide that additional context if that is considered relevant. Was there anything else in the question? Sorry, Rebecca.
I can add something onto that last bit if that's okay, Caroline.
Yes.
So I think one of the important things here on this materiality assessment is that one of the decisions we made in S1 is that where a company has had key judgments that it's had to make that have really influenced the content of what's included in their disclosures, then that is something you would provide information about. And this could be a good example. If it was really hard to judge whether a particular category of Scope 3 should be included or didn't need to be included, it was hard to assess and it would have made a big difference which way you went. That might be a good example of the sort of additional information that should be provided so that an investor can look at that and say, oh, do I agree with that judgment? Don't I agree with that judgment? Can I ask the company a few more questions about that? Because it will be an area where judgment will be required. And so I think that would be the way, another good example, thanks for setting it up for us, of why S1 and S2 are really important to be thought about in combination, I think.
Yep.
Great. Let's see. So many questions. We'll certainly do our best in our remaining time here. So Sue, we're getting some questions in the chat around industry-specific disclosures. We've provided industry-based guidance, but we do require industry-specific disclosures. Could you comment on how companies can approach this?
Yeah, and this is a really important area. So I'll go back a little bit and remind us all what was in the proposals and then where we landed and why as well, maybe because it might be useful context, hopefully. So in what we put out last year for comment last year, we had actually proposed that this Appendix B that was in the exposure draft would be required disclosures. So we said that a company must provide the disclosures for it as set out in Appendix B for their industry as part of their climate disclosures using the standards. People came back and said they weren't certain that the information would always be relevant all around the world for industries. And there were questions about whether more time might be needed for people to familiarize themselves. And so what we decided as a board was it was really important that industry-specific information is provided, so something that's sort of relevant to your particular activities. I always give the example, climate's really different for an airline, for a food company, for a mining company. So the information provided that's relevant is really going to vary. But we took on board the comments we got and said, okay, so for now, we'll provide as a help examples from the ISSB standards, which were based on what was exposed as Appendix B, because as Caroline rightly said, this is a really great way to help a company think about which disclosures might be important for their investors, given their activities and industries, but using it as a source of guidance that you refer to and consider, but you don't have to apply it, because you could conclude that something different is actually more appropriate in your circumstances, is really this balance between being helpful, ensuring there is industry-specific information, but not dictating its exact form. So that's sort of the path that we took, and that's why we went down that path. So that means that we do think this information, it is industry-specific information, definitely does have to be provided, but the exact form of it doesn't have to be as set out in the examples that we included in the standard. That's how we've balanced the feedback that we got.
Caroline, here's an interesting question about the link between climate policy engagement issues within jurisdictions and climate-related disclosures. Could you expand on how S2 considers international climate targets?
Yeah, absolutely happy to, Rebecca. So we, as mentioned earlier, we don't require companies, or the IFRS S2 does not require companies to have climate-related targets. But if companies have climate-related targets that it is planning to achieve, then information is required to be provided. So in this instance, it could be that a company is required to meet a climate policy-related target, and this could therefore be relevant information then for investors, because there is a risk that, there are risks and opportunities associated with meeting and not meeting those targets. There's also, and I wasn't sure if this is what the question had in mind, but there is also the specific instance of the latest international agreement on climate change. So currently the Paris Agreement, which presents climate-related risks and opportunities for companies in many jurisdictions due to the sort of the breadth of those targets in terms of NDCs, for example. And so in that specific instance, the board decided to include a requirement in terms of how, or for companies to explain how it has, like how that international agreement or those jurisdictional commitments to that has informed the target. So for example, it could be, when companies are looking to kind of meet their obligations in terms of the Paris Agreement, there are sometimes commitments both in terms of things that they're looking to reduce at a jurisdictional level or subsidies that they're looking to introduce. So it could be things that a company might look at as they're setting targets. And again, what we are, or what IFRS S2 is requiring, is that if a company has been, or is to explain how that international agreement has kind of informed the target that it is set.
Great. Another question here about how this all relates to the ESRS standards. So we touched on interoperability between ESRS and ISSB in the last webinar on S1. So I don't want to go into too much detail here because we are running out of time. But maybe, Sue, is there anything specific you might want to comment about interoperability between ESRS and ISSB, where it relates to climate specifically?
Sure. So we've been working hard with our friends in Europe to try to make sure that we reduce the risk of companies having to do two quite separate things to meet European requirements and ISSB requirements. So, for example, to ensure that if you're measuring greenhouse gas emissions, you can do it in the same way for both sets of standards. So we spend a lot of time aligning disclosures wherever we can. So there's a lot more alignment in where we have landed in the most recent version of ESRS that people have seen. That's the first thing. The second thing is we've identified where there are some disclosures that we require that Europe doesn't, at least just yet, finance emissions notably. And then we've identified quite a few disclosures that Europe requires that we don't because of their broader focus. What we hope to do is to provide mapping information to our stakeholders so they understand how they can present their disclosures in a way that would enable them to use the same disclosures to meet both sets of requirements, and to present the information in a way that would enable them to both meet our investor information needs and their European reporting obligations. So we're working towards that efficiency. You can't just pick up one set of standards and meet the others, but there is a path to get to a good outcome. Quick enough, Rebecca?
Yeah, great.
Yes. Excellent.
Another one here in our last few minutes. I think this one's for you, Sue, as well. We are getting some questions around the task force on nature-related financial disclosures. Could you comment how the ISSB is engaging with the TNFD?
Sure, and I'll make maybe three quick comments on that. So we're talking to the TNFD, given they also sort of starting with the TCFD recommendations and structure. That's a helpful starting point in terms of us having good interoperability. Just next week, we've got a board meeting where we're going to talk about some potential additional educational material for the application of S2. And in there, we're focusing in particular on some very climate adjacent aspects of nature. And we've said there that we'll look at the TNFD work to see if there's some examples we could use to build on their work. So that's one really important example. We've got an agenda consultation out at the moment where we asked what we should work on next. The first topic of 4 that we have in that consultation is a potential project on biodiversity, ecosystems and ecosystem services. And we ask our stakeholders if you guys all think we should, build on the work of the TNFD there. So that's another relevant touch point for us. So we've got conversations going on both of those things. And last but not least, I would say that when you apply S1, of course, after the second year, you are required to report on risks and opportunities beyond just climate. And so there you would need to think about nature-related risks and opportunities. And so you need to think about nature there, but that's not directly relevant to this S2 conversation, but for completeness.
Great, thank you. Last question here, I think that we have time for, and we'll start with you, Sue, but Caroline, if you want to add anything, please feel free. One question that's come up a fair amount is around climate as a risk and an opportunity. Is the ISSB saying that climate as a topic is something all companies will face risks and opportunities around? Therefore, all companies will be expected to use S2?
I never say all as a standard setter because materiality is an entity-specific judgment, so we can never say all. But my expectation would be that there is probably aspects of climate-related risks and opportunities for most companies because it's just so pervasive. Whether it's, you've got your own plant and machinery or somebody in your supply chain that's subject to wildfire risk, flood risk, whether it's because of something to do with either the products you sell or the inputs that you need, where the cost of them, the availability of them, or the appropriateness of them, and whether you need to replace them is going to be affected by, policy requirements around climate change. I think there's really, many things everybody needs to be thinking about. But also think it is important to focus on the opportunities, which is a bit different from the TCFD, at least heritage. We do acknowledge that opportunities are also really important to talk about as well. Some companies will have products that are going to do really well in this new climate environment. Some people are going to have really clever transition plans that are going to give them a leading edge. And so those things to me are both examples of opportunities, and investors really want to hear about that. And that's a great way for companies to attract capital when they're in those situations. So we're equal access in terms of risks and opportunities.
And Rebecca, maybe just to add to that, materiality isn't just a magnitude question. So again, sort of when we speak to investors, they tell us that it may be material information to hear of companies that have very low emissions, for example. So I think that's just a final thing to consider when looking at S1 and S2.
That's such a good example that I'm going to add 30 seconds onto it, if that's okay, Rebecca, without getting in trouble. If you're in an industry where investors would expect you to have a really high level of emissions, either directly or in your value chain, and actually you don't, that could be really important information for an investor, which is what makes it material, because it wasn't what they expected. And so that's material because that could influence the way they think about a company and its investment decision. So Caroline's right to say it's not just quantitative, it's qualitative as well. And sometimes a small number can make something interesting.
Great. Well, thanks so much to you both, Sue and Caroline, for letting me fire off all these questions and your quick responses there. And thank you to everyone for joining us today. Like I said, we will send the recording, the slides, and the transcript of the presentation for this call, and we'll include S1 in a follow-up email to you all, at least by the end of this week, if not before that. Stay tuned for more educational events like this one from the IFRS Foundation. Check out our website and social media channels for more programming like this, really available to everyone. And if you are interested in learning more about the IFRS Sustainability Alliance, our membership program where we connect members in dialogue and bring together peers around this evolving field of sustainability disclosure, you can contact us at sustainability_alliance@ifrs.org to learn more. With that, thank you everyone for joining us. Thank you to our speakers, Sue and Caroline, and I hope you all have a great rest of your day. Thanks very much.